Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jonathan Farr, Private Markets Director at Homrich Berg, Edward Fernandez, President and CEO of 1031 Crowdfunding, and Jason Barsema, Co-founder and President of Halo Investing. They join me to discuss what to consider when making an investment in private alternative assets. It is great to have all of you with us, gentlemen. Welcome to Trade Talks. Let's just go around the horn here quickly. Jonathan, we'll start with you. Give us some background of where you sit within the private asset space.
That's great. Thank you. Homrich Berg is a $16 billion RIA outside of Atlanta, and we're a little bit unique. We offer our clients unique exposure in the alternative investment space through internal fund of funds and private equity, private credit, real estate, and hedge funds.
And let's learn more about 1031 crowdfunding.
Yeah, so we actually created a platform to allow investors who are a little tired of dealing with the tenants, the toilets, and the trash, and come down to that crunch time of 45 days and have the ability to invest in passive real estate while still deferring their taxes.
And Jason, finally, Halo Investing.
Yeah, Halo is a financial technology platform that has disrupted and democratized the $3 trillion market of structured notes. So we provide our technology to financial advisors all around the world that gives them liquidity, transparency, and customization around this very large market of structured products and annuities.
Jonathan, let's talk about the current private market environment right now. It's certainly gaining more traction. We're starting to hear more retail investor interest in it as well. What's going on in the market right now with private assets?
So previously, private equity and private credit have only been open to very large institutional investors. And more there's been interest from individual investors and RIAs in this space to gain exposure to those asset classes that have premium returns and are a little bit more difficult to navigate. The high points of private markets today, we're seeing a slowdown in private equity as rates have increased. There's slower transaction volumes across the market, but still really good opportunities in equity. The demand in private credit's been absolutely insatiable. The market's grown 30% CAGR over the last 10 years, and clients are very interested in that space. Every loan there is floating rate, so we're seeing very attractive returns on a risk-adjusted basis, and it's a good source of income for our clients.
Right. And Jason, let's take a step back here for a moment. What would be considered a private asset?
Yeah, in my perspective, right, Halo deals with structured notes, which is not a private asset. It's a way to get investment protection, against an index or against a stock or a commodity or currency. When I look at the private investment market, because I'm heavily invested in it, it's similar to what Jonathan was talking about: private equity, venture capital, real estate, really anything where your money is locked up. It's not necessarily liquid on a day-to-day basis, in my personal opinion, as a private investment. And while that can be good, I think a lot of advisors need to consider what those liquidity constraints are for not only their own portfolios, but most importantly, for the clients.
Right. And of course, Edward, from a macro perspective, is the environment having any impact, whether it's positive or negative, on the private markets?
No, not really. I think investors are kind of looking for that non-correlating asset, right? Something that they can actually look at their balance sheet, it's not changing every day. With the uncertainty that's going on with the economy, I think these private assets actually provide that benefit or that feel of safety.
Right. And Jonathan, let's learn more about the investment process here from HB's perspective. What do you look for when you're looking to invest within the private market space?
That's a great question. So just to say it, there's no public market for private investments. There's a lot of boots on the ground work to determine what opportunities are available. And then when you make investments in the private landscape, whether it be equity or credit, you're usually underwriting a partnership and a team to manage capital for 10 to 12 years. So you want to understand everyone's background, you want to understand their track record, you want to understand their investment process, and you want to understand the opportunity set, since these are illiquid bespoke vehicles. No magic bullet when you're doing due diligence, but usually takes about 4 weeks of spending a lot of time with the underlying investment managers and understanding the opportunity set.
And Jason, if you could follow up on that.
Yeah, and to that point, right, is that I think it's important for investors to understand the hold on these investments, right? Whether it's venture capital, private equity, private credit, these aren't liquid investments, and these aren't 1 to 2 year holds to be able to maximize the value. So as Ed was talking about, we're searching for uncorrelated returns in the market, but investors really need to be able to balance that with sometimes the liquidity constraints that these products have, and ultimately what their risk and reward objectives are in the portfolio. And that's why structured notes can be very interesting as a kind of counterbalance and complement to those alternatives. They give you the public equity exposure with protection while still being able to complement the uncorrelated returns that other private investments can provide.
Right. And Edward, with all this information that we're learning right now, it sounds as if a professional should be helping investors when it comes to determining what type of asset fits best in their portfolio.
Yeah, that's going to come based on the client's profile, right? How old are you? What's your strategic goal as far as your portfolio is concerned? Investors should not be investing a huge sum of money inside these non-correlating assets. And that's why the reason why it's important to have suitability standards for these type of investments, so that an investor has a cash emergency. They're not looking towards these non-liquid assets to fulfill that need.
Right. And Jonathan, is private alternative investments, is it for every client, or do you have to be a little bit more discerning?
It's not for every client. Liquidity is a big constraint there, and it's something that we think about when we're offering these for clients. A lot of funds require you to be an accredited investor or even a qualified purchaser for different private equity and private credit products. There's a variety of structures and investor requirements available across products. One thing I would say on the liquidity front is that not all private investments are created equal. Hedge funds will sometimes offer quarterly liquidity, but then again, the manager does not necessarily have to provide it. They'll sign up to offer liquidity for a certain percentage of the fund, and you can end up in a queue. In private credit, we're seeing some really innovative structures out of managers. These used to be structured like private equity funds, where you have 4 to 5 year drawdown and then a 4 to 5 year return of capital. Evergreen products are becoming very popular, and folks are offering private credit, especially in structures that were traditionally you'd think of as hedge fund structures with quarterly liquidity.
Mm-hmm. Jason?
Well, and I was a former wealth advisor, and ultimately, as a wealth advisor, we have to think about what our clients' objectives are, right? And holistically, it's to grow our wealth at a reasonable rate of return. It's to preserve our wealth because we work really hard for it, right? And we need to generate a level of income. And that's why I think is when you look at everyone on the call, we complement each other so well, because clients need that upside of the public markets, say the S&P 500, but we can't afford to lose our money, which is why investing with protection is really important. And then you complement that with the yield, with the potential uncorrelated returns that you can get from real estate, private credit, private equity. And now venture capital, I think, is actually looking quite interesting in this market, which was the most hated market over the last 2 years, where valuations are. Venture capital is starting to look quite compelling. So that combined approach, I think, is what advisors really need to think about. It's not just about risk and return. It's also about those liquidity needs, but it's not all or nothing. You can have a balanced portfolio to satisfy both.
All right, Jason, did you think this valuation reset over the past couple of years was something that had to happen? I mean, even if you think about it from the public perspective, by the time a lot of these private companies got to the public markets, I mean, they haven't seen their IPO price since, right? So do you think this valuation was necessary when you kind of think about moving away from growth at all costs to, the balance sheet and revenue sources and proper governance and so forth?
Well, it goes back to my comment about liquidity needs, right? Where the venture capital world really got into this zone where, hey, I'm going to have a 1 to 2 year hold and I'm going to flip it in the IPO and I'm going to make a lot of money, where traditionally venture capital is a 5 to 7 year hold, as Jonathan was talking about. As a result, you got a flood of assets into the VC market, which obviously is supply and demand. Valuations went through the roof. Some were justified, some were not, but it is what it is. Now, I think you've seen such a retracement in regards to the private markets with some of the capital protections that you have with investing in venture capital, like liquidity preference. And that's why I start to think this can be quite compelling, because it's low valuations plus some nice covenants within some of these VC deals that I'm personally seeing.
Mm-hmm. Edward?
Yeah, so, it's interesting that you talk about reset. The real estate market really hasn't reset yet, but I think the debt markets have, right? So with interest rates going up where they are today and loans being reset, now is an opportunity not to just look at stabilized assets, but look at assets that you can turn around and create wealth. You could be rich, but this is the time with real estate that you can actually get wealthy by taking advantage of those opportunities.
Right. And Edward, you had mentioned in your notes here that one of the most misunderstood areas of private investing for most investors are REITs, right? Within
Yes.
the real estate space. Explain to us why.
Because, you know, when we speak to investors, a lot of investors use the term REITs, and they're really talking about equities, right? So then when they have a portfolio allocation, they have traded REITs in their portfolio, but we have publicly registered non-traded REITs, which do not actually correlate to the equity markets. And then you have private REITs. So depending on liquidity needs, you know, true real estate is not a traded REIT. It's buying shares. That's buying shares in a real estate company. If you really want to actually really take advantage of true real estate, you have to have the share price or the net asset value be tracked by the actual value of the real estate, not some stock.
Right. Are there areas within real estate that are more attractive than others?
But right now, for us, it's senior housing, assisted living, and memory care. There's a term called the silver tsunami that's coming in 2025, which says that 10,000 people will turn 85 years old every single day. And in order to meet that demand, there has to be 800,000 additional units being built in the next 6 years. And that's a huge opportunity to take advantage of that need.
Mm-hmm. And Jason, I think it's important to note too that alts are not necessarily a silver bullet or, you know, the answer to finding alternative sources of income within a portfolio.
That's exactly right, right? Alternatives, I always joke, tend to be the junk drawer of one's portfolio. When we don't know where it goes within your asset allocation, we throw it in alts, right? But I think alts can be very powerful, right? Private equity, venture capital, real estate, senior loans can all be very powerful. I think the issue that we're dealing with right now, Jill, is a global macro environment that's very uncertain, right? And so ultimately, what I like about structured notes and protective investing, it gives you that defined protection against market declines, especially in a world where we're looking at interest rates that could be higher for longer. We're at 4.64 on the 10-year treasury. And from experience, sometimes higher interest rates don't always bode well for investment performance in REITs, as Ed was talking about, because they can be directly correlated, or utilities. So as our country is getting older, we need to balance the income needs, which you can get not just from your alternative portfolios, but also from the liquid side within our portfolios, because as we get older, we also need liquidity. Liquidity is a premium in volatile times, and that's what investors should be considering.
Mm-hmm. Jason.
Yes.
Yes. You were looking to follow up there.
Oh, I was just responding. And so at the end of the day, right, I just...
Oh, I'm sorry. You know what? You are. I am sorry about that, Jonathan. Too many J's going on here and a Jill.
Yeah,
Jonathan,
that's okay.
I'm sorry.
Call me anything you want, Jill.
Yeah, I think Jason hit on a really important point that all alts are not created equal. You'll have some asset classes like venture capital where you expect a very high return over, call it public equities or even other private equity, where you have very limited liquidity. And then you can also dial an alternatives portfolio more toward buyout, which would turn a little bit more quickly and have more liquidity, a little bit less expected return, or move into something like private credit, where you can have monthly or quarterly distributions from interest payments. So when we say private assets, that can mean something that pays you monthly or quarterly, or something that's a long-term 10-year plus play for you.
Right. And Edward, I want to ask you, with so much retail interest right now, do you think that could impact the private space at all? Or because we just keep hearing more about private credit and there's so much retail investor interest and so forth, that couldn't skew the market or, influence investments at all?
Well, I think it does. I think now that the retail investor has the opportunity to invest in institutional quality type products, I think it does change the landscape. I mean, for example, you have a lot of accredited investors that are trying to get into real estate that are, or non-accredited investors trying to get into non-correlating assets. And because they're non-accreds, they can't. But then comes the Reg A Plus offering, right? From the Jobs Act. So now you can get a non-correlating asset for a non-accredited investor, and that's definitely going to change the landscape on how people invest in real estate.
Yeah. And Jonathan?
And we're seeing the same thing in private credit. These things used to be only structured in drawdown funds, only for qualified purchasers and institutional investors. And now the largest asset managers in private credit are raising BDCs that may trade publicly that anyone can buy and benefit from the attributes of private credit.
All right. And the right, Jason, we'll give you last words here.
Yeah, I think at the end of the day, advisors need to weigh the risk and reward needs of their clients' portfolios along with the liquidity needs of their clients' portfolios. If you're looking for income, alternatives can be a great play, but structured notes can be an amazing way, especially with high interest rates and high volatility. Right now, income-oriented structured notes are providing yields of anywhere from 9 to 11% on major indices. And for me, where I just want to make 7 to 8% of my portfolio, that can be quite compelling in these uncertain times.
All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.
Thank you, Jill.
Sure.